Welcome back to the channel, guys. I've got the crypto tax expert in Australia for you. I've got Adrian on the line here. It's an interview that you've all been waiting for such a long time. So I'm glad to have him today with us and sharing his time. So yeah, thanks again for joining us, Adrian.
Thanks a lot, Jason. Thanks for having me on.
No problems at all. So for the guys who don't know, Adrian has a company, Crypto Tax Australia. I always get all the wording mixed around.
Yeah, that's
A
right.
bit dyslexic like that. Okay, Crypto Tax Australia, and based in Melbourne. So if you want to know about taxes and how it all works, Adrian's one of the go-to guys in the space. Yeah, tell us a little bit about like how long it's been around and what got you into this, and then we'll jump into
Yep,
the questions for the guys.
yep. So I guess probably the question that people ask the most is, when did you get into crypto? And probably the first time I heard about Bitcoin was back in 2013, when a friend told me that Bitcoin had got to $1,000, and I said, "Oh, I'm not going to buy some, fake $1,000 coin." And obviously, fast forward a few years later, back in early 17, then I started hearing about it again and got sort of involved again. As sort of time went on, I realized there wasn't any accountants really that were dealing with the tax situations in Australia specifically. So in September, I started out small. September 17, started out small, helping people with their tax returns and their calculations and some advice. Back then, there probably wasn't much guidance in terms of, how everything was treated. I know the ATO, a little bit selfishly, put out some guidance on the 29th of June, basically the day before the end of the financial year. So people basically had 24 hours to get their stuff together, do any sort of planning that they could beforehand. And so now I've been doing this basically for, 3 years now. And our firm specifically focuses on cryptocurrency investors, traders, businesses, people that do mining. Probably I'd say 95% of our clients are in crypto. So it's basically our core businesses and something that we do all day, every day. We're also investors, of course. I'm a big believer that you need to use the product to know what you're talking about. It's not just the theory. So a lot of the time we would advise clients, not in a financial advice sense, but in terms of a tax and how it would all work, how some of these different protocols work for DeFi, the exchanges. The space has changed so quickly, especially in the last year in the DeFi space, and there's so many things that are going on and new projects coming out and different, I guess, models of DeFi for the same sort of outcome sometimes. So it's always interesting, and there's never a dull moment in crypto. So
Not at
it's
all.
I know, yeah.
Yeah.
So it's been a great journey, I think, and especially coming from 17, 18 when we had a bit of the last small bull market, if you can call it that now. And then we went through the crypto winter, and now obviously dividends have been paying off for those people that stuck around, which is good.
Yeah, and got in early again through
Correct.
early 2019 and
Yeah.
rode out the first pump, and then the
Hmm.
false leg up, and then we went. So being that it's your business day in, day out, that you're in crypto space, that's one thing that I've heard from other people looking to do their taxes. You know what well, we hope you know what you're doing. Obviously, that's why you're in the space, crypto tax. That's going to save, I assume that saves people time, that you've got systems already set up. Whereas,
Hmm.
I don't know, I'm throwing a number out there, 99% of accountants have no idea about cryptocurrency. And so
Yeah.
essentially, if you're to use them, then you're paying them to learn on the job. And it's kind of an expensive
Correct.
exercise to pay someone 100, 200, whatever it is
Correct.
per hour to learn.
Yeah.
So that's one benefit to use a specialized crypto tax expert.
Yeah. Yeah. We speak the same language as our clients. So if you did go to another accountant, you would have to teach them to say, oh, what's a wallet? What's an exchange? Then you start talking about yield farming on DeFi and all this sort of stuff, and their head would explode. They wouldn't know how to use a block explorer, that type of thing. So, yeah.
Especially with the staking coming out, and then you're getting all these little bits of income as well.
Correct.
So you probably heard all the regular questions that people ask. You said you're on just before we got on the line today, you had like 5 back-to-back calls with clients. I had a post up on my community page on YouTube. There's like 100 questions or 100 comments on there. A lot of them are very similar. I assume you probably already know what the main things people ask. How do I not pay as much tax? What are the best ways to do that? Do you want to just hit us with a few of those answers?
Yep. So I probably want to clarify a few myths, and I want to go through them really quickly. So one of the myths is, look, I don't have to pay tax until I cash out to Australian dollars. That's definitely not correct. It's all about when you make a trade in between a coin, regardless of if it's Australian, US, crypto, Bitcoin to Ethereum. Every single transaction is taxable, and that would include disposing your crypto for a personal asset. So let's just say, for example, I've held Bitcoin for a year. I then want to use some of my profits to pay for a subscription, or you can use Living Room or Satoshi to pay for bills or whatever. That's also a disposal as well. So that's probably the first myth.
Disposable just means it's a taxable event, therefore has to be recorded, and then you have to pay tax on that as well as the product that you just bought.
Yeah, correct. Yeah. So you would calculate what your normal gain is. So it's essentially a barter transaction. So you're receiving that product in the equivalent of Australian dollars of what you paid for it. So that's how you would work that out. So I guess in terms of
so that's myth number 1.
Yep, that's myth number 1.
There's quite a few questions of that. So it doesn't matter what you're trading between. Australia says it's a taxable event. We'll get to some of the other things later, but that's myth number 1. And before we go a little bit further, the main thing that we talked about earlier was that this is obviously general advice. It's not specific to anyone. And there's just no way that we can give you specific advice in one video, especially when there could be thousands of people watching. So just that's the disclaimer on all of this.
Yeah, I guess it just all depends on your personal circumstances. What your other income is, what your portfolio is like, what type of investor or trader are you, what's your family situation, what's your goals, that type of thing. It's really tailored in terms of what you should and shouldn't do from a tax perspective as well. So yeah.
All right. Myth 2.
Number 2, a few myths. Things like staking. Some people think that aren't taxable. So staking is really something that's considered similar to, say, interest or dividends. So
that's the way the government treats it.
Yeah. So from a tax perspective, so if, for example, you have, and I'm talking Australian here, if you have, say, shares in BHP, then you would get paid a dividend, and you'd need to declare that dividend in your tax return every year. So irrespective of whether or not you received the cash payment of the dividend or you received shares as a dividend reinvestment scheme. So a lot of staking now, you would get paid in the same coin for locking your coin up. So, if you're staking Cardano, there's obviously hundreds of different staking coins.
Cardano is fine for an example, yeah.
You'd get paid in Cardano, and you would need to declare that as income, and then that would usually, form part of your pool if you've got like a reinvestment in the pool, or depends if it's going to the same wallet or a different wallet. You'd need to declare that as income, and then moving forward, that Cardano's cost would be the market value of what you received it for. So at the moment, I think Cardano is about $1.20 US, something around there, or it was. I know it was.
I'm just thinking of that. So essentially, say you have 100 Cardano, just as an example, so people can get an idea of the numbers. You got 100 Cardano, it's about 5% per annum. You receive 5% or 5 ADA per year, but Cardano pays out on their epoch every 5 days. So 5 into 365, I don't know, how many is that?
Yeah, it's about
70 or something.
60. Yeah.
So say it's 70. Divide the 5 by 70. You end up with like call it 0.2 of a Cardano. I don't know. 0.0, something stupid. So 0.1. Then you have to note how much Cardano was at that time that you received the 0.1 Cardano. So it's $1.10 or $1.20 at the moment. So what 0.1 of that is 12 cents. So then you're paying tax. If you get to that bracket, then you're paying tax on the 12 cents. So that happens every 5 days and you have to record that. Is that how?
Correct. Yeah.
Wow. Okay.
Yeah, it is. Yeah.
You have software to do that.
You do. That's right. Yeah. There's heaps of softwares out there now. I mean,
I think I've got a couple on the channel too. It's like Coinly and CoinTracker or something like that.
Yeah. There's some good ones and some bad ones. There's obviously some that do more than others. It just all depends on what your portfolio complexity is like. If you're really someone that would, just buys and holds, you probably don't need some complicated software to do all that sort of stuff. Again, none of the software are perfect. They don't do everything, but they will do 80% of the work for you. So, people sort of ask me, do you use spreadsheets? And we do sometimes for different purposes, but as a portfolio capital gains reconciliation, it's very difficult to keep that, especially when you've got multiple coins and multiple purchase dates and multiple sales. It's almost impossible. And the legwork to do that it's not worth it. You rather pay the software, $100 or $300, whatever level it is, to help you do that. It's not worth it. And the software is a tax deduction as well, because it's providing you assistance in preparing your tax affairs. So,
sure. So that was myth 2. I think we got there.
Yeah.
You still have to pay tax on anything that's income related from those cryptocurrencies. Staking, masternode rewards, interest earning, yield farming, anything of that nature.
Correct.
Was there a myth 3 or
well, there's probably I can probably think of at least one more. Probably 2 actually. And I'll just try and remember both of them. One's the personal use asset. So a lot of people, especially on social media, circle this myth around. If you put less than $10,000 in, you don't have to pay tax in Australia. That's a complete. I think it's a bit of Chinese whispers what happened there. That specific rule basically states that, in plain English, states that if you are buying a personal asset worth less than $10,000, on the intention that you've bought the crypto to purchase that asset, then it'll be tax-free. So as an example, if you need to, let's say there's a subscription that you needed to buy, and the subscription only accepted Bitcoin as payment. So the only way that you can buy that subscription is if you sent Bitcoin for that payment, not Australian dollars or US dollars. That would be seen as a personal use. However, you need to, if you had held the crypto for a long period prior, you need to look at what your intention was for that crypto from the beginning. So let's say I bought Bitcoin a year ago, And then a year later, I said, okay, well, I'm going to buy, some subscription online, for instance. Initially, what your intention was to invest in Bitcoin. So if you wanted to buy that subscription, essentially, and I know this sounds a little bit orthodox, but you'd probably need to buy Bitcoin again and then immediately send it off to show that there was that intention of buying, of using Bitcoin to purchase that subscription. So that's just a little catch there as well. So usually it's not going to apply for most circumstances. One example where it may apply is where you would have something like, the crypto.com or a CoinJar card.
Sure. Yep.
There's a few others now. Yeah. What tends to happen, and some of them work a little bit differently, but sometimes what would happen is, let's say you've got a crypto.com card, you would send some Bitcoin to that crypto.com card. Sometimes, I can't remember if crypto.com do it, but it would either sell down the crypto into Aussie dollars, or sometimes I think it's Singapore dollars for crypto.com, and then you would use that to pay for things. So the only real reason to have that type of card is to spend it. You don't use, the intention of a crypto card is not to store your crypto. You would use something like an Exodus or a Ledger or a Trezor or something like that to store the crypto. So in that example, let's say you transferred $1,000 of Bitcoin, and then there was $1,000 that was stored in this card, and every time you make a purchase, it sells the crypto or the Bitcoin in there. Okay, in that example, it's probably going to be seen as more personal use, because your intention became from when you sent it over to the card. Any fluctuation in the price would be ignored for capital gains purposes and be, capital gains exempt moving forward, if that makes sense.
Is there a limit on how much then you send to the card? Say you want to buy something worth 50 grand or 20 grand.
Yeah, I mean, it's got to be a little bit reasonable. I think 50 grand is probably excessive.
So you couldn't buy yourself a car with that?
You could, but again, if you've been holding that crypto for ages, when you move that Bitcoin into the card, that's when the sale is going to happen anyway.
Oh, that's the taxable point there, and as long as
Correct.
It stays on. So could one way then be every time you buy cryptocurrency, you transfer it to the card because your intention is to spend it, and then you could hold it on the card for a year?
Yeah, you'd probably need to be spending it fairly regularly. I wouldn't be holding it on the card for 2 years, because it's not really being used as a personal asset. Yeah. So it's just being, the ATO always comes back to what would a reasonable person do? And that's what you've got to ask yourself in that instance.
It's goddamn ATO. Reasonable. And they'll make it up whatever reasonable is at the time.
Correct.
Yeah, okay. They get the grey book and we get the black and white one. I see how it works. Yeah. Okay, so then we got to myth number 3. Is there a fourth one?
Myth number 4, yeah, probably. One question I get asked a lot is, if I gift crypto to someone, can I avoid paying tax? In Australia, no. That is really considered basically an arm's length transaction. So, Jason, if I was to gift you 1 Bitcoin, then essentially I would be, and you didn't pay me any money for it, irrespective of if you paid me $1 or if you paid me $100,000 for it, that would still be seen as selling it at a market value.
So it's 70 grand and you gave me 1 Bitcoin at the current price of 70 odd grand.
Yeah.
Then you would have to pay tax on that, not me.
Correct. Yes. Yeah.
All right. So you've
So
given it away, and then you're like, where am I going to get this money from?
that's right. Yes. Gifting only really works if it's to family members. If you keep it within the family,
Is there a
you
limit on
might.
that then?
No, there's no limit. No, there's no limit. But again, there's going to be the tax to pay. If you're sitting on a big unrealized gain of $500,000 and you just gift that to your brother, you're going to
What
have
about
to
to your
pay tax.
child? Like we have kids, and people want to give crypto to their kids to hold for 20 years or
Yep,
something.
yep.
Yeah, the tax
Again,
then, yeah.
you'd still have to pay the tax. Yeah.
Who, at what point, and which tax return do you look at? Which year?
So it'll be in the year that it happened. Look,
Oh,
ideally, I
okay.
like to go back to audit trail. So if you were to gift that to a family member, you'd want to see some sort of on-chain transaction to verify and go back and show and say, well, look, this is the transaction when I transferred it from, my wallet to my son's wallet or my daughter's wallet, whatever it might be. That is when the taxable point happened.
All right. So I buy one ETH for 2,000 Aussie dollars,
Mm-hmm.
transfer it straight away to a wallet that I set up for my daughter. And then when
Mm-hmm.
she's 18 or 20, I can give her the card or the wallet, and there's no other
Yep.
tax to pay on that.
Yeah, until she sells it. Yeah.
Oh, so if she goes to spend it in 20 years' time and ETH's gone from 2 grand to 200 grand, then she has to pay tax on it then.
Yes. Yeah. Yeah.
All
Yeah.
right.
Yeah. So yeah, that's just one thing to be aware of because that can catch people out a few times where especially when you're like a husband and wife, and I wouldn't recommend transferring crypto in between each other, and using the same wallet unless you've got some sort of agreements in place or if it's through like a family trust structure because it can get complicated in terms of someone gifting it, another person buying it, and vice versa. And then when you've got using the same hardware wallet, well, whose Bitcoin is that one and whose Ethereum is that one, and it gets really messy, and you don't want to.
Yeah,
Yeah, yeah.
totally. I can see that happening. Um, I mean, look, we can move on to some other questions, especially around like what's the best way to structure yourself. Yeah, because I was just thinking about all of that transfers going on there. Oh yeah, so structuring yourself, and then also if you find yourself in this situation now, so something that you could do to make things the best way possible. And then the other question is, well, if most people find themselves in the position where they've just sort of gone out and bought crypto now, no structures in their personal name, no plan. What can you do at that point? So the best case scenario and the current case scenario, starting
So
with the best.
yeah, okay. I mean, look, ideally, it's going to come back to what your personal circumstances are.
Sure. All
It's
general.
always yeah. It's always best to plan first. And again, it's all in hindsight, right? I mean,
Mm.
a lot of people didn't think the run that we're on was going to go as crazy as it is. I mean, I personally didn't. Some people probably did. Um, and if everyone knew, they probably would have set up all these structures and bet the house on buying Bitcoin and all these other alts. But it all depends on what your outlook is going to be over the coming years. Are you going to sell out within a few months, or are you going to continue to invest in crypto for the next 2, 3, 4, 5 years, and beyond? So having some sort of structures in place, depending on your circumstance. So a typical situation might be like a husband and wife. And if they're long-term investors, something like a trust structure would probably be more suited for them, because you get the advantage of having a 50% discount on capital gain on assets held for longer than 12 months. And you also get the discretion of where you would like the income to be distributed to. So if, for instance, the wife's earning $100,000 and say that the dad's at home looking after the children, or vice versa,
It's very
when
21st
you
century of you.
Yeah, I know. I wanted to use that example instead of the normal scenario.
Usually because the
Um,
dad's at home screwing around on the internet trying to make money
that's
off
right.
crypto. Yeah,
That
okay.
yeah, that's exactly right. Yep.
Yeah.
Yeah.
Then
Well,
wife's
now
like,
they
where'd all
are.
my money
Now
go?
they are.
Yeah.
Now they are.
Yeah.
Um, no, it's usually the husband that says, just give me your photo, honey, and take a photo, and I'll just sign up an account in your name. When I have one-on-ones with people, I always ask. It is a very male-dominated industry, but I do always ask the girlfriend or the wife, do you know if something happens, touch wood, do you know what to do? Do you know where the codes are, and all that type of stuff? Because it's
Definitely.
something that's going to be very important. It's things that I've touched on in the past about estate planning,
Mm,
where if something happens, the value of some clients' assets are very high now, and in 5 years' time, who knows where they could be. And if you don't obviously have backups and private keys, and your spouse doesn't know what's going on, something happens to you, you obviously want to leave that wealth to your
to your family, of course.
to your family.
Mm.
um, so I mean, we're sort of working through different solutions at the moment. Over the coming months, it's on the agenda list of trying to help clients in that area as well, because I think that's going to be a lot more important moving forward.
Yeah, I've also started thinking about that and just like, what's the cheapest way for me to bring money back in, but then even get it into my super fund, because that's a big one that I go on about a lot. Because
Hmm.
the super fund, they can access. If something happens to me, they can access it.
Yep.
That's the way I've looked at that, as
Yep.
sort of like wealth planning or estate planning. So,
Hmm.
um, yeah, sorry, you were saying there, but we were in the middle of best case scenario, setting up the structure, or at least that was a
Yeah,
possible
yeah. So, so,
solution for the
so,
best
yeah,
case.
so, yeah. So, I went on tangent. So, if in that example where the wife's earning 100,000, the dad's not, let's say you make a big gain in 1 year. With a trust structure, you're able to distribute the profit in a percentage term or in a dollar value term of where it should be allocated to, in relation to the tax brackets of that individual. So, let's say you make a profit of, let's say, 300,000. Now, in Australia, the highest tax bracket is 180. So anything over that, you're taxed at a big 47% tax rate. So it's always best to try and, if possible, keep your income below that level. Um, so in that example, if you've made 300, the wife's already on 100, you would probably distribute $100,000 to the wife and $200,000 to the husband. So they'd both be on the $200,000 mark. I know it's a little bit over the 180.
Hmm.
In comparison to, say, having the wife already on 100, she earns 300,000, which gives her a total income of 400. That would mean that 200 grand of the or 220,000 of the gain would be taxed at that highest margin rate at 47%.
Mm.
So in Australia, we have that progressive tax system where the first 20 grand is tax free, essentially.
Yeah.
$20,000 to 45,000 is 19% tax rate. 19 to 120 is at 34, 37, and then you get to 47,000. So, between that dollar and 180, there's a huge tax saving if you can spread the income around. And that's why trusts have traditionally been used for investment assets and that purpose.
That's a discretionary trust.
Correct. Yeah.
Yeah.
Sometimes it's also called a family trust in
Family
some
trust.
instances.
Yeah.
Yeah.
You don't need to set that up underneath a company, or it always is set up underneath a company structure. It's like you're a
Um,
trustee of the company. Yeah. Yeah.
Yeah, so you would always, and every lawyer or solicitor would tell you this, to always have something, a company as a trustee. Um, and the reasons, there's for crypto, I specifically think it's good because, one, it gives you the separation of assets between the company as trustee for the trust and you personally, a lot of exchanges will only allow you to open up a trust if you have a corporate trustee as well. And it's also obviously for asset protection purposes. So if you're, a doctor, an accountant, a lawyer, or a builder that has, a high chance of getting sued, if you are the personal individual trustee, then if you get sued, your assets are exposed in that trust. So that's why it's always better off. Yes, the cost is a little bit higher. It's an extra $8,000-9,000. It's still a tax deduction, but in the long run, obviously when you're dealing with the gains of crypto, it's a bit of a drop in the ocean to make sure that it's all set up correctly from the beginning.
Yeah, and that's why this is very general information. It just depends on the person and how much they're looking to invest. So looking at crypto and the potential to earn 10 times your money or 100 times your money, depending on if you were, I wouldn't say smart, but if you got it early in 2019 or 2020, and you're giving me an example, say people putting 10 grand into Theta and now it's close to $1 million, then that might be a good use case for a structure like this. However, if you're someone getting in early 2021, January, February, you're throwing in $1,000, $5,000, $10,000 now, then that structure might not be so beneficial. Depends, obviously. If you're getting into some altcoins that are 10 million market cap and they go to $1 billion market cap and you're throwing, 10 grand into that, then sure. But if you're just buying the majors, Bitcoin, Ethereum, we probably don't think they're going to do 100x from this point.
I guess it depends on your time horizon too.
Sure. Okay. Good point.
Because, and it also depends again on your other income. Because if you're having that type of structure, then you still can distribute, even if you make 100 grand, let's just say, you can still distribute that profit where it needs to go instead of having it in your personal name. Because, a lot of times clients would also always come to me after the fact and say, hey, I've got all this money, I've invested in my personal name, like the Theta, you put 10 grand in and it's worth, $750,000, I think. And there's not really much you can do 2 years down the track. So again, it depends on your time horizon. Yeah.
All right. Maybe in that case, then you just ride the wave up and ride it down and just pay yourself an income from it, sell off 80 grand a year or whatever tax bracket you want to fall under, and just call it a day, pay you 35%, vary whatever it is. Okay, so then with the company structure, it's something around, we'll just talk about that as well, 25% you would pay in the company. And once that's paid tax, so you make 100 grand, you pay your 25% because that's the tax rate for companies. Now you've got 75 grand. If you distribute that to yourselves personally, you then have to pay tax on that again as income.
Yeah. So I'll go back a step. So company structures primarily are used for more short-term trading portfolios. And when I say short-term, I'm talking about less than 12-month investments. Companies don't receive the 50% discount on capital gains, irrespective of how long you've held them for. So if you bought Bitcoin for 1,000 and now it's 10 grand, and you've held it for 5 years, and you've made $9,000, you'd still pay 25% tax rate. Now the 25% comes in to effect 1st of July this year. This financial year that we're in, 2021, it's at 26, I think it is 26%.
We're not going to notice too much difference. Percent here and there.
Yeah. Primarily, a company is used for short-term trading, so that would really be used for short-term alt trades, yield farming, even things like providing liquidity, getting interest on stable coins. That type of thing would be most beneficial in a company structure in comparison to your personal name, which you're probably going to be paying I would say a minimum of 34% tax, or 34.5 on your personal return. So, Binance, FTX have got US dollar lending. Sometimes you can get between 10 and 30%. If you've got some money in there and you're getting an interest yielding, it's better off having that in a company. I've even been saying to clients that when you're taking some profits, perhaps put it in some of these stable coins to earn yields, because that would be, I guess, your profit taking, and then leave it in the stable coin, and when the tax is due, you pay the tax with the US dollars. You don't have to pull it out into Australian dollars. You might as well keep it in some sort of stable coin, and earn a yield. The only downfall for that is obviously there's the US dollar and the AU dollar exchange rate, which is a small risk there. But it's obviously not as volatile as keeping it in,
Sure.
something like Bitcoin or other alts.
Yeah. And then we've also got that one. I've only seen that one minor option of true Aussie dollar on crypto.com, so you can buy that and stake it over there. I don't know if you've seen that.
Yeah, I think it's Celsius. Yeah.
Celsius has that now.
Yeah.
Yeah.
Yep.
Crypto.com had it as well. I don't know if they still do.
Okay. Yeah.
But anyway, that's one option. Okay, so I think we kind of answered both of those. That was like the best way to structure yourself. If you had your time again, or if you're just starting out, depending on what your horizon is. And then we talked a little bit about like sort of worst case scenario, if you're already in this position, what you could do. Do you want to just summarize those, and then we'll just quickly do a few questions?
I probably let me go back a minute, because I think I probably missed something. So,
there's a lot we can miss in this one.
Yeah, I know. I'll give you an example of what I did for a client a few weeks ago. So they'd been a client for a few years. I think they lost money in the 18 or 19 year, and they went full-time crypto at the start of July 2020. And I think to date, probably in February, I think they had made about 250 grand by doing yield farming and speculative alts and that type of thing. Now, that would mean that he's already in the highest tax bracket. And based on his circumstances, he's really classified as a trader for tax purposes because of the nature of what he's doing. So automatically, irrespective of what he does, his taxable income for the financial year is going to be 250,000. So what we talked about was it might be better off to move some of those assets, or at least half of those assets. I think you probably will do the full amount into the company to then continue trading and doing, the yield farming and the speculative alts and that type of thing, to be capped at that 25% tax bracket. Because at the moment, if he makes another $100,000 between now and June, that's going to be taxed at 47% straight off the bat. So that's an example where you can do it sort of halfway through the year, if you're already at that peak. And he trades crypto full time. He's in a lot of private groups, a lot of private groups where you need a certain amount of coins to get into pre-ICO type coins. So he's got some very good opportunities. So in that example, it's obviously helped him immensely. So,
all right.
And then going back to the structure point of view, as a company, then we set up what's called a trust structure underneath, which then gives him again more flexibility on where he wants the profits to go, because he's got a wife and he'd like to distribute the profits to her later on. So. Yeah, sometimes it gets complex like that, but it's just talking through examples with clients on how it can work for you.
Yeah, and that's what you do with the consultations.
Yeah.
All right, I'll have a link to that in the description down below. I think it's 10% off 10% off for
Yeah,
their
for new clients.
for
Yeah.
new clients' tax return
Yeah. So any initial preparation work that
preparation.
needs to be done. Yeah. Yeah.
Yeah,
It's
but you
10%
got to
off.
use
Yeah.
that link down below for the viewers of this channel. Yeah,
Correct. Yep.
cool. Thank you for that. All right, we got through pretty much a large bulk of most of the questions I could think of. I've read through them and pretty much answers a lot of the people's questions here. People sort of like, how do we report our investments? When is a capital gain because you spend Bitcoin? We've talked about things like that. Tax rates on crypto, it's the same. We talked about companies and personal tax rates. So for tax purposes, what's the difference between crypto investing and trading? We also talked about that in terms of the structures, correct?
Yeah. So one question is, how do I be considered a trader or investor? It's not a one. It's not a tick box where, if you do 500 trades, you're a trader. It's really looking at your overall circumstances, in terms of, how regular are you, how much money is invested, what sort of training, what's your experience, do you have entry and exit points in terms of your trading. Just because you bought, I don't know, let's just say theta, for instance, two months ago, and then you sold it for a nice healthy profit today, doesn't mean that you were trading that. A trader would normally look at a price target they want to get into, and then set, sort of sell orders or stagger their buyers out. And that is more of a trader. And it all, I guess, it depends on the exchange you're using and that type of thing as well. So, what other income have you got? How much time are you spending? Because traditionally, crypto, you do a lot more crypto trades in crypto than you would in the traditional market. You don't do 500 trades or 300, 200 trades on ComSec normally. Where in crypto it's very normal to do that. So it's just just so much faster paced.
I think the smaller percentage in and out helps make those, I wouldn't say irrational, but those quick decisions over and over again. You're only paying 0.5% or less to make a $10 trade or $100 trade, $1,000, whereas bloody ComSec stabs you with 20 bucks every time.
Yeah, they do.
Yeah.
Yes.
Yeah. So okay, I think we got through
it's not
the bulk
instant
of it.
either.
At ComSec.
I think there used to be T3. I don't even know if it is like that anymore.
I thought you could still get it.
Yeah.
Oh.
I mean, crypto is 24/7 too, so the market never sleeps. So.
Oh, right. Yeah, I'm thinking, if you're just trading within hours that they're open, you can do it at market. But if it's after hours, I guess you got to wait for the open. People who are watching to this point, let us know what you thought. Comments, questions down below. Like the video up if you found some value from it. Subscribe to the channel. Plenty more of this coming out. And for the guys in the membership or in the Investor Accelerator membership, which you can find a link to in the description down below, Adrian will show his face in the group every now and then, help out with a few questions here and there.
Yep.
Yeah, just to steer people in the right direction. It's,
for sure.
It's not financial advice. He's not here to answer your questions all day long, but for the guys there, we can do a little bit here and there closer to tax time. So that's the added benefit for the guys in the group as well. So thank you very much, mate.
No problem at all.
Any last words?
I'd probably say one thing.
How did I know you're going to say yes?
I think people do get caught up in tax a lot. But remember, the saying goes, you don't go broke taking profit. And sometimes it's better to take the money and run, pay the tax and be happy than, I mean, I don't want to be put the video on a downer here, but you look at 17, 18. A lot of people got in at certain times and wanted to hold for that 1 year period, and by the time that came around, the coin was in a major loss. So it's really about trying to be smart about what you're doing in terms of in the investing side as much as it is tax. because you don't want to throw away those gains just for tax reasons. A client spoke to me 2 weeks ago and said, I didn't want to sell. I needed to wait like another 2 months because to get a 50% discount. I think this was on Aave when it went from 550 to 300. And he said, look, I lost 100 grand in 2 days, which would have paid for the tax twice over. So don't get caught up in the tax. I mean, I personally sold some coins in January, February that I bought in August, which didn't fulfill the 12-month discount. But I knew when things went a little bit parabolic, and I think it was probably near the two Bitcoin peaks.
The peaks, yeah.
There was time to take some profit. I put some back into the market on the dip, and then kept the rest, in a stable coin and earning interest. So I think don't get caught up with, how much tax you're going to pay. If you do take profits, take some out and keep it aside for tax as well. So that's just, you don't want to get caught with your pants down sometimes, in a year's time having to pay the tax and you haven't got the money there. So that's a real big one.
Totally. And I think we've only really scratched the surface of all of this. There's plenty of other ways people could do it. We even off camera, we're just talking about this whole nomad thing and offshore and all this sort of stuff, which is not like your specialty thing. It's already deep enough just trying to do crypto and tax in Australia, especially because it's so new with all of the gray areas from the government and the ATO. But we're pretty much not limited to this. We'll leave it on a positive note that there are expanding ideas out there. And I think I'll get into those later in some other videos, maybe with some guys who are in that nomad offshore space.
Yep.
Cool.
Yep. Beautiful.
All right. Thanks again for joining us, mate. We'll catch you in the group, and I'm sure we'll do another video shorter than this.
Yep.
Getting closer to tax time or just after tax time. So if you want to check out Adrian, or you want to talk to him about tax, link down below. They just email you, I think, or go to your website and just fill in a form there.
Yep. Yeah, perfect. Yep.
Perfect. All right, guys. Thanks again, mate.
Thanks a lot. Thanks
Cheers.
again.
All right. Catch everyone next time.
Bye-bye.
And until then, have more fun, get more done. Cheers. Peace out.